Good morning. Happy Friday. Hopefully you've had a terrific week. I hope so. Today I'd like to talk about credit reports. And credit report fees have been in the news a lot recently. In fact, today I want to touch base on an article from yesterday's HousingWire titled "Credit Reports Will Be at Least 20% More Expensive in 2025, Frustrated Mortgage Executives Say." And the article is by Falvia Furlan Nunes, who does terrific in the HousingWire. I'll give you a peek at the article right now. FICO score increased their prices by about 40%. They're now $495 per score. So to try and merge, you need 3 scores. That brings us to $15. And then every other person every other company in the delivery line, the credit reporting companies, the try and merge aggregators are all going to add their fees. And so it's expected the end cost to the user, which is the lender, is going to go up about 20%. And so today, the average cost of a credit report, a tri-merge credit report, is somewhere between $100 and $120. So let's just, for the sake of math, call it $110 per credit report. So that's what it is today. Now, we can't just look at, gosh, this is an extra 20% cost. We have to look at what's the overall impact on our business. And to understand that, we need to look at a few things. One of the most important things is what's our policies around charging the borrowers? Do we collect upfront fees or do we not? And then what is our conversion rate? And so I want to do some back of the napkin math. And by the way, you don't have to agree with my math. I want to share my reasoning and then get to a concept and then talk about the implication of the concept. So let's just say a small IMB runs 1,000 credit reports a month. They run 1,000 credit reports a month. And let's say a small to mid-size runs 1,000 credit reports a month, and that they have a 25% conversion rate on credit reports. That is credit reports to closed loans. Now, you can argue that conversion rate is higher, and certainly every lender will tell you their conversion rate's higher than 25%. But when I look under the hood of companies, it seems to me their conversion rate from credit report to closed loans runs about 25-30%. But let's use 25% because it's easy math. So we got 1,000 credit reports a month with a 25% conversion rate. So we're going to close 250 loans a month. And let's just say the average loan amount is $350,000. Now, it could be more, it could be less. You can change the math and come up to your own numbers. But using that math of 1,000 credit reports a month, 25% conversion rate, and $350,000 average loan amounts, and the average tri-merge credit report of 110, what all that stuff comes down to is that today, a small IMB closing 250 loans a month has about a little over $82,000 per month in uncollected credit reports. So they have an expense of $82,500 on uncollected credit reports. And the question then becomes, and by the way, that equates to about 9.5 bips on volume. So uncollected credit reports cost about 9.5 basis points. So what's the impact of having a 20% price increase? Well, the average cost of a tri-merge credit report goes from $110 to $132. And the average uncollected cost goes from $82,500 to $99,000. That's an increase of 1.88 bips, almost 2 bips, which gets us next year, our uncollected credit reports will cost over 11 basis points, 11.3 basis points. And all this is back of the napkin math. And you can adjust your conversion rates and you can adjust your average loan amount and you can get to what your total is. But if we start to talk about 11 1/3 basis points as an expense for uncollected credit reports, that would account for over 60% of IMB's profitability in the Q3, right? Because IMB profitability Q3 was reported as 18 basis points and Q2 is 17 basis points. And so this will be a drag, 2 basis points right off the top, but it's an overall drag of over 11 basis points. And so the question is, how does the industry react? What do we do? And it's a problem because charging borrowers up front for credit reports creates friction with the borrower. And then downstream creates friction with the loan officer. But what are IMBs to do when profits are margin thin? And so will they start to, like brokers, charge for credit reports up front? Very possible. Will they include an application fee? Very possible. What will be the ramifications? How will the public react to that? How will it become a competitive advantage or disadvantage? Will they start to create, KPIs around loan officer productivity and expenses? Will they make things like uncollected credit reports a bigger number on the LO scorecard? And then if they include that in the LO scorecard, what do they then do with that data? Because you can have a loan officer that's prolific and taking applications and pulling credit reports, but is underperforming with closed loans. Say somebody that has a really weak lead stream, that has a bunch of weak online leads that they're just pulling a bunch of credit reports for, they're not closing. Does an IMB really want that loan officer to work for them? And are they going to pay attention in the future? And then you can even extend it into recruiting. When we recruit now, is it all just about volume? Is it about the type of volume, which we look at profitability, right? We do performas, we figure out profitabilities. Or do we start to look at what's your lead flow, what's your conversion rates? Because conversion rates are starting to become one of the most important factors on profitabilities. And lenders are just getting to this today. They're just starting to understand conversion rates are critical. I think the two most important things, to IMB is conversion rate and productivity of your database. How many loans per contact are you getting on your database? And then what's your conversion rate on new leads? Those are the two most important data points that every IMB lender needs to just be fanatically paying attention to and driving KPIs on. But it's interesting. The overall thing, it's an interesting conversation. It's just one more layer. It's part of running an IMB. It's part of being in the business. If you're a loan officer, it's part of managing your pipeline, managing your conversion rates, staying competitive, while still trying to deliver an excellent customer experience. And it's tricky, but that's why everybody gets paid. If it was easy, people would do it for free. So one more thing to solve, I thought I'd share with you. Great job on this article, HousingWire and Falvia. Great job. You can check this out. I did a LinkedIn post on it this morning. I gave you extensive data from the article. I gave you the back and the napkin math. You can easily do your own math. Check out my LinkedIn. I appreciate you guys stopping by. I hope you had a